Welcome back to the continuing saga of the principles of microeconomics offered at Austin Community College. We are going to talk about topic 33 with this little lecture video. But before we do, I hope that everyone knows how to find these lecture videos. I do have a post here on the announcements page and how to find it. It is kind of far in, that is deep down into the file structure. It says, you go to this main page, which I believe is the first page that comes up once you're into this course. And then you click on MindTap Applia, which is right here. Let's read the rest of the file structure. And once you're in there, you click on Applia assignments over exam 2, though right now I'm going to be recording for topics over exam 3. Week 10, lecture topics 18, 19, and 20 on elasticity, chapter 6, lecture topic 18, and lecture topic video. Let's see if we can't find that. Topic 18. So we click there. The splash page comes up. We then click on Applia assignments over exam 2 topics. We're going to take a look at week 10. This is the first week I started recording these lectures after school didn't reconvene because of the coronavirus. And we see lecture topics 18, 19, and 20. We also see the assignments from Applia MindTap here, the book, end of the chapter homework, which is practice, the homework, which is graded, and the numbers and graphs, which is graded. Let's get into topics 18, 19, and 20. Drop down another level, and we're going to take a look in the lecture topic 18 folder. In there, we find the PowerPoint, which is helpful. And, well, I have 2 videos here. One on the elasticity of demand and one on the elasticity of supply. Anyway, that's how to find these lectures. And if we back out a little bit, in fact, let's just go to MindTap Applia and get into Applia assignments over topic 3 for exam 3 topics. And I'm here in week 13 doing my lectures over 32, 33, and 34. This is chapter 9. These are topics related to chapter 9. We've already done 32. Let's get into the 3 topics. And we're going to do lecture topic 33. And we're going to open topic 33 PowerPoint up, which I already have opened here. Let's see if I can find it. Topic 33, here we go. I want to make sure that this is the one. Yep, yeah, it looks good. All right, and let's take a look at the question again. And by the way, I've opened up the lecture outline and topics, which are listed separately. In fact, if you go to lecture outline objectives and click on exam 3 and open it in another tab, you'll get this. So we've done 32 and we're on to 33 now. We need to sketch a graph of the average variable cost curve, the average total cost curve, and the marginal cost curve. And this is a repeat of 31, which we did by going through spreadsheet in which I constructed the cost curves from a production function. And so we're just going to repeat 31A here and 33A. And then we're going to label the shutdown point and break-even point using these curves. And our idea of marginal revenue to help us see where the firm might produce to maximize profits or minimize losses. And we need to explain why these are the firm's shutdown and break-even points. And basically the explanation is they will either maximize profits or minimize the firm's losses. And then we illustrate the firm's supply curve, which we had already sort of done up here in 32, but there we said it was the whole marginal cost curve. In this one, basically what we're going to do is see that which part of the marginal cost curve really is the firm's supply curve. And then we're going to add each individual firm's supply curve together in a given industry producing a product to get the industry supply curve. So let's get started by going through PowerPoint 33, and I'll open it right here. Want, of course, probably make some notations here. See what sort of drawing point. Yeah, that's probably okay. So here's A. I'm drawing cost, or actually some measure of money values on this axis. Price and cost actually could be there, and output is here, or Q. And what we should see from 31 is that the marginal cost curve should pass through the minimum point of the average variable cost curve and the average total cost curve. And recall that the marginal cost curve has this shape here, especially from its minimum point upward, due to diminishing returns, diminishing marginal product. And so marginal cost is inversely related to marginal product. So recall in an earlier one we had marginal cost, and we were ignoring variable material costs, so it really boiled down to the wage rate of each additional worker over the worker's additional product. And this wage rate was constant. We'll just put a line over it to show it's constant, while marginal product was falling, diminishing marginal product, diminishing returns. And you can see that this mathematical relationship would imply that the marginal cost is rising. So the marginal cost rising here is due to diminishing returns, okay? And then what follows is that this marginal cost curve then determines the shape of the average total and average variable cost curve because of the mathematical relationship between marginal and average. And that is, if the marginal value is less than the average, it's pulling the average down. If it's greater than the average, it's pulling the average up. And that goes for both the average total cost curve and the average variable cost curve. And remember the analogy I made to your grade point average. Basically, the grade in a course is your marginal grade, and your overall average is your grade in all courses. So if your grade in this course is higher than your GPA, it'll pull your GPA up. All right. So let's move then to the next slide, B. We need to talk about the break-even point. Let's see. Oh, I didn't test out to see if this link, this URL actually worked. It would have been best if I had done that. Well, let's just take a shot at it. I'll copy it, and let's see what we need to do. Now play around with the interactive graph at the bottom of the page. Choose P2. The profit maximizing output is Q4. This is the break-even point. We can also say that where marginal cost intersects average total cost is a break-even point. Well, let's go see if that makes any sense there. And enter. Let's see what we have here. All right, profit maximization for a competitive firm. Need a. Let's see if we can. How do I unblock that thing? Come on, let me allow it. Adobe Flash Fiber. Right, run the program. Darn, why doesn't that play? Let's see if it'll play in Firefox. Great book for my distance learning. And there we go. Run Adobe. Oh, good. It'll run in Firefox. Do you want to allow? Yeah. Oh, good. Oh, boy, this is a little small. Let's see if we can't make it larger. All right, that's good. So I think it said pick P2. And so if this P2 is the price the market sets, and these cost curves are for, let's say, the average or representative firm in the industry, the $97 is the price that the firm can sell its product at. It can sell as much or as little as it wants at that price, and that price is its marginal revenue. The firm maximizes profits by setting marginal revenue equal to marginal cost, which is right there. So it would produce Q4. And so total revenue is 97 times 168. Total cost is also 97 times 168. So profit is 0 because total revenue and total cost are equal. Total variable cost is there, and total fixed cost is right there. Well, that's pretty cool. I like it. All right, let's reset that, and let's go back to our PowerPoint and see what we have here. So we found the break-even point, which is where the marginal cost intersects the lowest point of the average total cost firm. Now we go back to the site and choose P4. The profit maximizing output is Q2, and that's the shutdown point. Let's take a look at that. So I think it was P4. So now the market out here somewhere is setting the price at $40. The firm faces a $40 price and can sell as much or as little at that price as it wants. But it's profit maximizing, or as we're going to find out, cost minimizing decision is to produce Q2. And so it'll produce right there. And I suppose this is a shutdown point. I would suppose it continues operating from here on up, but below there it does not. So total revenue is 40 times 116. Total cost is, you can see, 131. times 116. Profit, you can see, is minus $10,556. It's losing everything in that pink rectangle. Total variable cost is there, and total fixed cost is here, which is equal to that rectangle. So the loss is equal to the total fixed cost. It would lose the total fixed cost if it shut down, and it's losing it now. I suppose it's indifferent. It wouldn't lose more or less if it stayed open, so I think it would stay open. But that would be the shutdown point. If the price dropped below the average variable cost curve, this firm would shut down. Let's reset and pick P5. There you go. Where the marginal revenue, now the price is 26, set by the market out here. Firm can sell as much or as little as it wants. The profit maximizing or loss minimizing decision is to produce at Q1. And essentially, it says incorrect because the price is less than minimum average variable cost. The loss is minimized at zero output because it would just lose the fixed cost. You see, here, the vertical difference between average total cost and average variable cost times output is total fixed cost. So it's losing everything, all its fixed cost plus some of the variable cost. Or another way to put it, it can't even cover the variable cost, much less any of the fixed cost. So it would be better just to shut down and not lose any of the variable costs and just lose the fixed cost. So any price below this minimum average variable cost means the firm is better off just not operating, just closing down. All right? Okay, let's go and see if they want me to play around anymore. So yeah, we did those. And now we're going to go look at some more graphs in the following slides. It says the following 4 slides. So it says the following 4 slides. Let's look at those 4 slides and come back. 1, 2, 3, 4. Okay. All right, so there are 4. We're back here. Oh, I guess. And then a decision tree, right? Okay. So when the price is greater than average total cost, slide 6, well, the firm is going to be making a profit. Let's go to it. So here you can see the price. This is marginal revenue, which tells you the price is 15 in this competitive situation. So marginal revenue equals marginal cost at 100 output. And total revenue is 100 times 15. So we look at average total cost is per unit cost, and that's $11. Yeah, it looks like it's almost at the minimum, but it's actually a little bit above. And so that's $1,100. And so total revenue minus total cost should give us a profit of $400. So yeah, the firm would definitely produce right here. There's no doubt about that. So let's take a look at, so the firm definitely produces here. And the fixed cost, by the way, is the difference between the average variable and average total cost times the output. So you can see that's 4 times 100 would give you a total fixed cost of 400. All right. So at this price, the price not only is covering all of the variable cost, it's covering all of the total cost with some left over, and that what's left over are profits. Firm would definitely produce there. Okay. now we're where the firm won't produce at all. If the price is 4, marginal revenue is that the same as price. Marginal revenue equals marginal cost. The firm might produce 50, but notice that it cannot even cover all of the average variable cost. The cost, the average total cost, or the cost per unit, is 13. So total revenue is 4 times 50, or 200. Total cost is the cost per unit, 13, times output, 50, which is 650. So if you take total revenue minus total cost, you get losses of $450, negative 450. They don't have the negative because they have the losses here, but they're losing $450. And we already determined that the fixed cost is 400. Again, we can do that here. So 5 times 150 is 250, and 13 times 50 is 650. So essentially, 650 minus 250 is 400. That's the fixed cost. If they operated, they'd lose 450. If they shut down, they would only lose their fixed cost. So the choice is lose this or lose this. And economists are saying not only are the firms profit maximizers, they're loss minimizers, so the firm will shut down. They won't produce at this point. And as we had seen in that other little interactive, the shutdown point is right here. All right. Very good. And let's take a look at one other graph. And this is where the price falls somewhere between the low point of the average total cost curve and the average variable cost, somewhere in between, somewhere like $9. And so here, the firm, if it produces at the point where marginal cost equals marginal revenue, so marginal costs are the same as marginal revenue where they cross. It doesn't look like they got this quite in line. They're saying it's 80. So if you then take this up to the average total cost, what we see is that the cost per unit is $10. They're producing 80, so total cost is 800. So the price is 9, and they're producing 80, so that's a total revenue of 720. If you go 720 minus 800, which is profit, remember, I should have written this out before, economic profit equals total revenue minus total cost. All right. And so that would be 720 minus 800, that's negative 80. They're losing $80. But as we said before, their fixed costs are 400. If they shut down, they're going to lose 400. If they stay open, they're going to lose 80. So now it's a choice between losing 400 or losing 80. They're going to choose to lose 80 in the short run. So at any price between the low point of the average variable cost curve and the low point of the average total cost curve, in this range here, the firm is losing money, but it's losing less money than if it shut down. So it will stay operating in the short run in this range here. Okay. And above it, it's making a profit. It's losing money here. Below the average variable cost, it's losing so much money it won't even stay open. So now we reach the decision matrix and we take a look at the price determined by the market in a competitive industry. And we ask, is it above the average total cost? And it could be yes or no. If it's yes, well, obviously we continue to produce because we're making profits. So profits are greater than zero if it's above. All right. Now, if the answer is no, then we have to ask another question. Is it above average variable cost? If yes, well, we do continue to produce. Profits are less than zero. They're losing money, but losses are less than fixed cost. So the firm is minimizing losses here. All right. So what about if it's below? Well, no, you shut down because if you stayed operating, you would lose more than your fixed cost. You shut down again to minimize losses, okay? So there is a whole decision matrix for a firm that wants to maximize profits or minimize losses. Where should I want to do this? Firm, whoops. Let me start over here. Wants to maximize profits or minimize losses, okay? And so the conclusion is this, that the short run supply curve of the competitive firm is its marginal cost curve, but not the whole curve. This part of it, no. But starting at the low point, at the shutdown point, this, of course, is the shutdown point. And I've always wondered how to talk about that. I always think it's best to say that this QSD is a shutdown point, all right? And then the supply curve looks like this. If we drew in the average total cost curve, and it's supposed to go through the minimum there, I suppose the firm at Q, this would be the break-even point. Break-even point. So above, the firm is making profits greater than zero. It's losing money here and output between here and actually the prices. So let's say price shutdown, price break even. So between these two prices, it would operate in here, but it would be losing money at, if the price of the product was above that, it would be making profits. So minimizing losses, making profits. All right. And let's see what we got here. If the price a firm can get for its product does not cover its average total cost, it's going to make a loss. That's just what I'm saying. But it may still produce at this level of output if the price can cover its average variable cost. So as long as it can cover all of its variable cost and some of its fixed cost, it will be minimizing its losses, okay? If revenues are covering all of its variable costs and some of its fixed costs, if it's shut down, it would still have to pay fixed cost, so therefore it's minimizing it. Let's build a supply curve for the whole industry. And here we do a horizontal addition of all existing firms' short-run supply curves. And what I'd like you to remember is that each of these supply curves are the marginal cost curve of the given firm. Marginal cost of A, marginal cost of B, marginal cost of C, and then this is a sum. This here is a sum. You can see at P1, A will produce and sell 10. At P1, B will produce and sell 8. At P1, firm C will produce and sell 18. So 10 plus 8 is 18, plus 18 is 36. So we're just imagining, that this, we didn't want to have hundreds of firms because it'd be too much for us to add all that up. And this will illustrate it. If there are 3 firms in the industry, the market supply curve will look like this. At P1, 36 will be supplied. So now we're back to here, and basically we've seen this several times this semester. The market supply curve then equals, and I'm going to put a little wiggle sign above, approximately the sum of the marginal cost curves of all the firms in the industry. And remember that the market demand curve approximately equals the marginal utility of the goods to the consumers, okay? And so this is basically your marginal benefits. And of course, this is your cost. It's interesting to think of this cost. The firms, of course, this is any point on the supply curve is the minimum price needed to bring this quantity to market. Obviously, they'd be willing to bring that amount to market at any price above. So I don't know if we can do these in different colors. Let's make this one blue if we can. And so basically any price up here, they'll be happy to sell at, right? They have to cover their marginal cost, essentially. Okay, that's good. And now let's go to the red one. And the marginal benefit. So this is the most. Consumers, the demand curve just shows the most that they'll pay. So they'll be willing to pay less, of course, than that all along here. And the only place they overlap is right in here. And let's just highlight that. So this is where deals can be struck, right? And actually, remember, this was called social surplus. It consisted of, if we can draw, here's the equilibrium price, P sub E. It consisted of, I'm not sure how to mark this, all the things in here are consumer surplus. And I don't know. What should we do? What does this one look like? This green one. All in here, this greeny thing is, I don't know what kind of color that is. Producers What color is this business? I'm not even sure. Surplus. And so if we add consumer surplus to producer surplus, we get social surplus. So in other words, exchange happens here where both parties gain. Remember that whole thing in capitalism, the capitalist theory, both parties to a transaction expect to gain from the transaction. The total gain is social surplus. And that, my friend, is the end of topic number 33. So I'll see you on the other side in topic number 34, which will be the end of chapter 9. And